Okay, so today's video is going to be kind of a fun one. How can we beat the stock market every single year? With big returns and massive dividends, how do we do it? How do I do it? Today, I'm going to talk to you about how you can do it as well. So first off, how do I invest? Well, if you've seen any of my videos, I am a massive dividend investor. I love dividends. The higher, the better. The higher growth of dividend, the better. I also like my growth stocks. I talk about the ARK ETFs. I really like Cathie Wood. If she was my age, I would want to go out with her and probably marry her because she is so smart and I like smart people. So, of course, how do I do it? So, first off, 80% of my portfolio is in dividend stocks, dividend ETFs, high dividend stuff. So what I mean by that is stuff like ZWK, TXF, ZWC. These are all massive ETFs that I hold. I hold the Canadian banks. But before I keep on going, let's actually check out a statement across 8 of my trading accounts that are with TD. Of course, I've got other accounts, other places like Wealthsimple and all that, but this is kind of the conglomerate of most of my money. So yeah, let's go check it out. So over the last 12 months, we can see that there is a 53% return on investment for me. Now, if we start looking over, this was started, of course, last July, and we can see that, hey, I got a 0.1% increase in July, and then it went up from that point to August, 1.8%. From that July to September, 7.8%. And now this is when I really start separating myself from the market. And over a couple of month period, you can really start seeing my separation very, very massively. So when we look at, for example, this is the S&P 500. When I had a 16% return from July, they only had a 7% return. Now, of course, we've had some massive growth anyways. You don't usually see a 30% increase on the stock market. Usually a stock market only has around an 8% return every single year. I try to get around 12% to 15%. That's my goal. And then, of course, I like to have a high dividend, which helps. And then, of course, I always try to get as much as I can. Now, 20% of my holdings is in riskier, higher growth names. Stuff like the ARK ETFs, Tesla. I wish I had Nvidia. I've been thinking about that stock for a very long time. Now, when we start going back down to this, you can see that, hey, I've got some pretty massive returns on this to a point of, back in June 18th, from July, I was at 54%. Now, of course, the stock market's pulled back a bit since then, but that's what you can see. So overall, that is how you can essentially have a greater return. And that is by essentially having 80% or somewhere around there. You want to have a big portion of safe bets. Now, safe investments. So for example, those ETFs I was mentioning, I like the Canadian banks. I really like a lot of the blue chip stocks. Now, when it comes to riskier bets, of course, yes, I go into some pretty crazy risky stocks. For example, weed stocks are really good. I like those, especially for the future. Some tech stocks, Tesla, things like that. But that only holds, or part of, about 10 to 15% of my holdings. I keep about 5 to 10% in cash, and then the rest is in safe investments. And I know there's some people who say don't have any cash, invest 100%, but you have to have some money for either a rainy day, or you have to have some money when it comes to, hey, like, there's some, let's say the stock market plummets. You want to be able to get in. So you want to have some cash. You don't want to be fully invested. The cash, you can get basically minimal interest, because interest isn't really a thing anymore, but you can at least make something with that cash, but what you're hoping for is to have a very big amount of money that you can say, well, I'm just going to drop all my 5 or 10% of cash into the stock market because now it's had a massive downturn. Also, kind of read the street. So this is something that kind of saved my butt during the recent downturn in the market. Is I watch a lot of the crazy conservative news, what they call essentially fake news, because I want to see what the so-called crazy people are saying. And the so-called crazy people were saying back in December that Taiwan was seeing a very massive virus coming out of China, and that they were even thinking of closing their borders to China in a way of like even diplomats even being able to come over. And of course, Taiwan and China don't get along anyway, so that wasn't really a big surprise. I kind of looked at that and said, well, they don't get along. They're in perpetual word wars all the time. Who cares? But that virus seems to be concerning to me, and I started looking at my stocks and saying, well, that's not paying me a dividend right now. I don't need to hold that. I've made my money on that. I can get rid of it. And I basically cut back all of the stocks that were a bit more riskier, even stocks that paid me a lower dividend. For example, Apple, that pays basically like a 1% dividend. Why be in that when you can then say, well, even if it does go down, I can get out of it and get back when the stock market gets lower, or I can invest in something else. And then, of course, the stock market went for a big tank, and I was ready to buy. And that's how you can really look at what's going on around the world. And if you see some crazy news, and you can then say, well, what's the chances that that's going to blow up? And you can kind of weigh your risks at that point in time. I was right, I was lucky. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.